Well, last week we changed our forecast for the Reserve Bank terminal rate in this cycle from 2.6% to 3.35%. We still expect that terminal rate to be reached in February, but we now expect not only that 50 basis point increase in August that had been the case in the past, but also 50 basis points in September, up from 25, and then a series of 25 basis point increases in October, November, December, and the final increase in February. By the time we get to December, we expect that the inflation rate will be printing 7.2%. So when the Reserve Bank meets for its February board meeting, it will have to digest a 7.2% inflation number. And we really don't think that they would be able to avoid raising rates for one last time at the February board meeting. However, by the May board meeting, when they get the report for the March quarter, we expect that inflation will have settled back significantly from 7.2 down to 5.9. And we think, given that the economy will have been weakening significantly, more about that later, and that the US Federal Reserve will have gone on hold at its December 2022 meeting, we think that'll be time for the Reserve Bank to go on hold themselves, hold rates at that 3.35% for the whole of 2023, with a likelihood of rate cuts in 2024. So why do we make that change? I think the most significant aspect of the changes was around three major communications from the Reserve Bank last week. These were a speech from the Reserve Bank Governor, a speech from the Deputy Governor, and the minutes of the July board meeting. And there were three key themes that were running through each of those communications. The first one was around the neutral interest rate level. That's the rate above which policy is contractionary and below which is expansionary. Now, we don't have a specific measure for that, but the Reserve Bank in the minutes and in the Governor's speech talked about a whole range of different ways in which they're measuring that number. And the Governor's conclusion was that most of the measurements concluded that the real neutral interest rate was positive. The nominal component, they settled at inflationary expectations, which they now believe it remains at around their target level of 2.5%. So 2.5% for the nominal, and if the real is slightly positive or even zero, it still means that the neutral rate in their mind is at least 2.5%. Now, we've expected it to be 1.5% to 2% based upon our assessment of Australia's overexposure to household debt. However, if the authority is saying it's 2.5%, we have to take that in mind, and given that we had 2.6% as the February rate, we hardly believe that the Reserve Bank would wait all that time to reach their neutral. Under the new profile, with 50 basis points in both August and September, they'll be at 2.35% and nearly that neutral level by the time we get to the October meeting. And from there on, it'll be sensible to move at a slightly slower pace, but still relentlessly moving towards higher and higher terminal cash rate. Other factors involved in the communications last week were the Reserve Bank Governor emphasised their need to contain inflationary expectations, to really weigh on that inflationary psychology. And in my view, such is the issue for central banks globally, the need to contain any wage price spiral, any lift in inflationary expectations, that they'll be prepared to err on the side of over-tightening the economy rather than run the risk of allowing inflation to get away and for stagflation to start building into the economy. And so it may well mean that growth will need to be lower than they may have been able to expect because they can't take that risk. And that's the second reason why we expect rates to be set at those significantly higher levels than neutral and hold them there for the whole of 2023. And the third reason was that, in particular, the Reserve Bank Deputy Governor gave a reasoned analysis of how they see the resilience of the Australian household sector today. They talked about the household buffers that have been built up as a result of the $250 billion of extra savings that have been made. They talked about the high current savings rate, that as that falls back, so that'll free up more money for spending. If you take the first quarter of this year, we assess that the savings rate fell from 13.4 to 11.4%. That freed up about $6 billion in spending, and total spending was only $8.5 billion. So as it moves back down to 11.4%, from 11.4% to around 6% this year, we expect that that will provide further cash to boost spending. But of course, by the end of the year, we're expecting that that savings rate will be down at neutral levels, and that boost will not be possible going forward. In fact, for this year, we're expecting that consumer spending will grow by about 6%. So what do these interest rate forecasts mean for the growth story? Well, with rates being held at such a significant margin above neutral for the whole of 2023, we expect growth to slow in 2023 from 4.4% in 2022 to only 1% in 2023. Associated with that will be a slowdown in consumer spending from 6% to 1.5%, and a 4.5% contraction in equipment investment in 2023. Now, the attractive results for the Reserve Bank under such a scenario will be, we expect that inflation that we think will reach 7.2% by the end of this year to slow to 3% by the end of 2023. And wages growth will peak at 4.5% during 2023 and start to come down. And one of the reasons behind that is that we expect the unemployment rate, currently at 3.5%, will be down to around 3% by the end of this year, but then start to lift as the economy slows in 2023, up from 3% to 4.2% by the end of the year, and up to 5% in 2024. So with that situation evolving and the need to really signal how important it is to contain inflationary expectations. And of course, today we saw the June quarter inflation report showing that inflation was in line with our expectations of 6.1%, with very, very strong growth in the cost of building homes, in fuel costs, and in consumer durables. Furniture, for instance, was up 7% in the quarter. So there is quite an inflation challenge at the moment, and a real challenge to contain those inflationary expectations. But we think, given that sort of a forecast for growth and inflation and wages, by the end of next year, having held rates well above neutral for the whole of 2023, we expect in 2024 that it will be possible for the Reserve Bank to cut rates back to around that neutral level. So we'd be expecting to see a 100 basis point cut in 2024. So it's quite a complicated story. And quite a concerning story about the outlook for 2023. But given what we've seen again today with those big inflation stresses, and with the concern that we have to maintain those inflationary expectations at around that 2.5%, we think that will be the best outcome for the Australian economy. Thank you very much.